Today, crypto starts the week with a comeback after last week's sell-off. New research shows more crypto investors are turning to stablecoins as a form of protection from market volatility. And Matt Savarese of Nasdaq breaks down the exchange's push into digital assets. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Digital currencies making a comeback over the weekend and starting the last week of November in the green. By noon Eastern, Bitcoin crossed above the $87,000 level. That's after last week's rout, which pushed the cryptocurrency as low as $80,000. Ether also in the black this morning, rising to $2,863. And after trading as low as $1.83 on Friday, XRP is in the green too, rising to $2.12. Okay, let's talk about the top stories. New research out today finds that stablecoins make up 9% of crypto's total market cap, a two-year high. That's according to data released by cryptopresales.com, which also noted that while many crypto investors chase high-risk, high-reward opportunities, more of them are turning to stablecoins as a form of protection from market volatility. Other reasons for the shift include clearer regulations, rising institutional interest, and increased use of stablecoins in cross-border payments, DeFi, and remittances. The report also pointed to CoinGecko data, which showed that stablecoin market share has risen over the past 5 months, signaling growing caution and a broader risk-off approach in the crypto space. Regulatory advancements, including those in the U.S., have only increased investor confidence and attracted more capital into the sector. Of course, the president signed the Genius Act stablecoin bill into law over the summer, marking the first major piece of crypto regulation to become law in the U.S. As 2025 comes to a close, it's a good time for crypto investors to look at new IRS record-keeping rules. New, stricter reporting requirements went into effect for this year, requiring brokerages to send a new tax form called a 1099-DA. It allows brokerages to report gross proceeds from crypto sales that they process. Beginning in 2026, brokerages will also be required to report gross proceeds and cost basis information. According to an example from crypto exchange Coinbase, if you bought 1 ETH for $1,500 and paid a $50 transaction fee, your cost basis would be $1,550, and that's what would later be used to calculate your gain or loss. So if you were to sell that same ETH for $2,000, your taxable gain would be $450. For more on crypto tax requirements, check out the story over on cnbc.com/cryptoworld. All right, for our main story, Crypto World's Talia Kaplan sat down with Nasdaq's head of digital assets, Matt Savarese, from the Clear Street Disruptive Technology Conference in Palm Beach, Florida last week. They discussed the exchange's efforts in the crypto space, including the Nasdaq's SEC filing to introduce trading of tokenized securities. Wall Street is looking to capitalize on the tokenization boom amid easing crypto regulations. And if the Nasdaq gets the green light, the move would mark the first time tokenized stocks would be allowed to trade on a major U.S. exchange.
Nasdaq has been involved in digital assets since 2021 when you launched the Nasdaq Crypto Index. And since then, Nasdaq has been immersing more and more into the space. I want to start off with the very latest because in September, Nasdaq filed an application with the SEC for a proposed rules change to allow for the trading of tokenized stocks and ETPs. So what was the main driver behind that move? I mean, obviously, we're hearing a lot of interest in tokenized stocks right now, so I'm sure that was part of it, but what else was in the mix there?
Sure. So the way we look at it is we filed a rule filing with the SEC that really allows our investors and members choice around how to settle and hold those assets and represent them. So either you can represent them in tokenized form now on blockchain, or you can hold them in its traditional form under the traditional accounts. And really what the whole purpose of this is to bridge the digital asset world and the traditional world together, but do it, and some of our responsibility is to really do it with an investor first principles type of mode. So we really looked at this as a way to kind of give investors that level of choice and to drive things forward. I think what's crucial here is that we're not creating a new exotic instrument. The stock is the stock, and that's what's really important, is that we focus to make sure that the investor is first and they have the full rights and title that the shareholder should have as part of owning that share. And what that really means is that when you start to trade that, that is the same ticker, it's the same CUSIP that's being traded, it's fully fungible between the token and its traditional form. It's just allowing the investor that choice on the back end to be able to hold it as new applications come forward and you have the enhanced utility of that instrument. So really we're thinking about the investor and making sure that they have right and title to the asset, which is contrary to some issuance that have happened. And you want to make sure that there are that same level of investor protections that exist relative to something that may be construed as a slightly of a derivative that doesn't necessarily have the exact right and title to that instrument.
So expanding on that, as you just mentioned, I know that Nasdaq aims to integrate tokenized assets into current market structures, and Nasdaq argues that current securities laws will apply. So how will this work exactly? Take us through what will change if the SEC does in fact approve this rules change.
Sure. So the nice thing is when we're talking about from a trade perspective, there's not much that happens day one from just the pure trade aspect of it. And that's deliberate. What we want to do is really bring the ecosystem along. So first and foremost is being able to interact with those shares in the tokenized form. So the trade happens through the order book under the same SEC rules that apply in the national market system. That was important because the rules that have existed for decades, and we don't want to just completely rip out and upend the entire process. So it was very important for us to make sure that we operate within the national market system, but allow to start to see the benefits of having a token and utilize those, whether that be on the post-trade processing, which this is, it allows the post-trade processing to exist in its tokenized form. And also, as new applications come on, to be able to utilize that token in those applications, whether that be in borrowing, lending, collateral, other use cases. We see those as being really the new and forward thinking of what a token can actually be used for. Within the trade and the match itself, it's still the same order book and the same investor protections that you exist and the same best execution that you would receive with the depth of liquidity. I think it's important to really identify that we're looking at keeping the same level of liquidity and that depth of liquidity that exists today. The United States is the envy of the world when it comes to really thinking about what liquidity is, and what we don't want to see happen is the fragmenting of liquidity across various different pools. You would see in stress times that those pools get very thin, and then you have more potential for disruption in the market. So our goal is to really keep that full depth of liquidity and be able to utilize the asset in more forms than it is today.
So what are some of the main benefits associated with allowing for the trading of tokenized assets on the NASDAQ? Obviously, improved efficiency, enhanced audit trails are some key factors, the potential for 24/7 trading. But what are some of the other advantages, if you can take our viewers through that?
Yeah, sure. It's a great question. I'm going to break this down a little bit to near term and longer term.
Sounds good.
So in the near term, you get a lot of process efficiencies on the back end on the post-trade side. So you can now settle in tokenized form. That ultimately, well, today we're looking at making sure that it's seamless with the back end processes that exist at our member firms. But over time, you could see where that can enhance the settlement, even speed up settlement, potentially to atomic instant settlement. However, you also have to think about, you have to bring the industry along with that, because coming with that, there's all of the additional mechanisms, whether that be financing or otherwise, that benefit from the capital efficiency that you get on the delayed settlement. But it is an area that we're looking at. Longer term, and even in the midterm, we think that the collateral mobility for these assets becomes very advantageous for the overall market. So being able to take that equity, put it into a collateral pool, allow folks to be able to move that asset instantaneously, can help along the lines of making sure that you have capital efficiency no longer needing to have to over collateralize positions. You're able to receive that collateral back and reuse it more efficiently. So I think it's important to realize that the utility comes with things that surround the asset itself beyond the trade, and that's where tokenization really comes through. When we think about 24/7, tokenization doesn't ultimately bring a forth 24/7, or liquidity for that matter. It's all about the market structure that you have around that. We're moving to 24/5 in our traditional markets, and the tokenization, I think, will wind up with our merging along the way in the longer term. But when you think about it, it's really that enhanced utility that you get from the asset beyond just the match itself. And then you can think longer term what the implications are. You can have better access for proxy. You can have enhancements around corporate actions and processing around those corporate actions themselves. So I think it's important to realize that you start to get the programmable nature of what blockchain is and smart contracts are intended for. You start to build into the equities, and it really helps facilitate the asset and the mobility around it.
Focusing on spot crypto ETFs, Nasdaq has been offering these products, including spot Bitcoin ETFs, spot Ether ETFs, but in recent weeks, we saw altcoin ETFs pop up, including Litecoin and Hedera, which are both offered on Nasdaq. So why was it important for Nasdaq to offer these products to investors on your exchange?
Yeah, so I think the way we look at it is we have rules around our listings, and we issued a generic rule filing. So this would be allowed for ETPs to come through and go through the process of the exchange listing, and as long as they reach those milestones that we set forth in our generic rules, then they should be allowed onto Nasdaq. And we from time to time update those rules, just like we do in all of our products. So we have gone through a rigorous process to file that, which was approved, and we're happy to have these products listed on Nasdaq.
Savarese also provided his 2026 outlook for the convergence of TradFi and DeFi. You'll be able to check out more of his interview over at cnbc.com/cryptoworld. All right, that's it for today, but we'll be back again tomorrow, and we'll see you then.